The dream of homeownership is changing. It used to be about young couples buying their first home. Now, families are coming together in new ways. Adult children are buying homes with their parents. High prices and a desire for multi-generational living fuel this trend. In cities like Toronto and Vancouver, it's becoming common. Young people struggle to buy alone, so families join forces. Parents help their kids enter the market or invest together. Sharing a home can mean support for all generations, but buying together is a big decision. Let's explore the ins and outs of joint home ownership in Canada. Buying a home with parents might seem unusual, but it makes sense today. Here's why more families are doing it. First, affordability. Pooling resources means a bigger down payment and a smaller mortgage. That can lower monthly payments. Second, support. Living together offers financial and emotional backup. Third, mortgage qualification. Parents' credit and income can help you get approved. Finally, it's a smart investment. Buying together helps you build equity faster. When buying a home with family, understanding the different types of joint ownership is absolutely crucial. The way you choose to hold title can have a lasting impact on your family's future and financial security. In Canada, there are two main options for shared ownership. First, joint tenancy. This is often referred to as the right of survivorship, a feature that sets it apart from other forms of ownership. If one owner passes away, their share automatically transfers to the surviving owner or owners, bypassing probate and legal delays. This can be beneficial for spouses, making things simpler, but can be complex in family situations with multiple owners. Second, tenants in common. Each owner has a distinct separate share of the property, which can be tailored to reflect each person's contribution. This share doesn't have to be equal, allowing for flexibility and customization based on your agreement. Upon death, an individual's share is passed down according to their will, giving them more control over who inherits their portion. This offers greater control over inheritance and can help avoid disputes among heirs. Choosing the right type of ownership depends on your family's specific needs, long-term plans, and goals. Consider factors like inheritance wishes, future plans for the property, and the dynamics of the relationship between co-owners. It's best to consult with a legal professional to determine the most suitable option for your family and to ensure your interests are protected. Adding parents to a mortgage can be a double-edged sword. On one hand, it can increase your borrowing power, but it can also complicate matters. Here's what you need to know. If your parents have excellent credit history, it can boost your overall application strength. Combining incomes can qualify you for a larger mortgage amount. Parents can also contribute to the down payment, reducing the loan-to-value ratio and potentially securing a better interest rate. But on the flip side, if a parent has poor credit, it could negatively affect the application. Existing debts of parents are factored in, which could limit your borrowing capacity. And lenders do consider age and income sustainability, which could be a factor for older parents. Taxes add another layer of complexity to joint homeownership, especially when multiple family members are involved in the purchase or ownership of a property. The Canada Revenue Agency, or CRA, has specific rules you need to follow, especially when it comes to capital gains tax and shared ownership situations. In Canada, you can generally sell your principal residence without paying capital gains tax, which is a significant benefit for homeowners. However, when multiple owners are involved, things can get tricky, as each person's situation may be different. Only one property can be designated as a principal residence per family unit at any given time, regardless of how many homes are owned collectively. If your parents already own a home and it's not their principal residence, selling their share in the jointly owned property could trigger capital gains tax, which may come as a surprise. It's crucial to understand the potential tax liabilities and consult a tax professional before making any decisions about buying or selling a shared property. And if a portion of the property is rented out, any rental income is taxable and must be reported to the CRA. The CRA has specific rules for reporting rental income and expenses, so it's important to keep accurate records and receipts for all transactions related to the property. While the legal and financial aspects are essential, don't underestimate the importance of clear communication and thoughtful planning with everyone involved. A co-ownership agreement is a legally binding document that clearly outlines everyone's rights and responsibilities, helping to avoid misunderstandings down the road. It should cover topics like who pays what towards the mortgage and how those payments are tracked over time. Property taxes, utilities, and maintenance costs should also be discussed and agreed upon in advance. Also, clarify who lives in the property, whether full-time or part-time, and under what conditions. And what happens if someone wants to move out or needs to relocate for work or family reasons? How will disagreements be handled? Consider setting up a process for resolving disputes, such as mediation. And what happens if one party wants to sell their share, or if the property as a whole is sold to someone else? Inheritance planning is also key, especially for families with multiple generations involved. Discuss and document how the property will be handled in the event of death or incapacitation, so everyone is on the same page. This helps ensure your wishes are respected and can prevent potential family conflicts or legal challenges in the future. For seniors, owning a portion of a property could impact eligibility for certain government benefits like old age security or the guaranteed income supplement. It's crucial to research and fully understand any potential implications before making decisions, so you can protect your interests and your family's future. Buying a home with family can be a wonderful way to achieve shared goals. However, it's vital to approach this decision with open eyes and a well-thought-out plan. Have honest conversations about finances, expectations, and long-term goals. Addressing potential challenges up front can really help prevent misunderstandings down the road. It's also important to consult with a real estate lawyer, financial advisor, and tax professional. They can provide personalized guidance and make sure you make informed decisions. By carefully considering all aspects and seeking expert advice, families can navigate the complexities of joint home ownership and build a secure and happy future together. Thanks for watching. Ravi and Parul Bagla here from Remax Realty Services. Please like, share and subscribe the channel, or you can contact us at 905-302-5070. We will see you in next video. Thank you.